Why saving money isn't always smart. 5 surprising truths. Is having a robust saving a vice or a virtue? We've been told since childhood, save your money. Put something aside for the rainy day. But here's the real question. Is having a robust savings always a virtue? Or can it become a silent vice? Hey everyone, welcome back to Street Smart Secrets, where we challenge what you think you know about money, success, and life strategy. Today, we're diving deep into a controversial but necessary conversation. Is having a large savings account always a smart move? Or could it be holding you back? Let's start with the obvious. At first glance, having a large savings account seems like the ultimate sign of financial discipline. And in many ways, it is. A healthy savings cushion protects you during emergencies, unexpected job loss, or medical expenses. It provides peace of mind and a sense of financial security. Someone with 6 months' worth of living expenses saved can weather a layoff or major car repair without spiraling into debt. Savings builds discipline. It gives you a safety net for emergencies. It protects you from financial shocks. Having a robust savings shows foresight. It keeps you from living paycheck to paycheck. It provides peace of mind. So yes, saving money is responsible. But here's the twist. After a certain point, saving too much and doing nothing with it can actually hold you back financially. Why? Because money that just sits in a savings account loses value over time due to inflation. For example, if you've saved $50,000 in a regular bank account, earning 0.5% interest, but inflation is rising at 5% annually, your purchasing power is eroding. That same $50,000 might only be able to buy $47,500 worth of goods in a year. If saving is the only financial habit you rely on, you might be unknowingly locking yourself into a financially limiting position. Here's 10 reasons why. 1. You start operating from fear, not strategy. When saving becomes your sole focus, your mindset often shifts from, how can I grow my income, to how can I cut back even more? Instead of looking for opportunities to expand, invest, or build wealth, you become hyper-focused on shrinking your expenses. This can lead you to avoid making calculated risks, miss growth opportunities, and settle for less in career, business, and life. Someone earning $2,000 a month who saves 30% may feel accomplished, and they should. But if they never learn how to invest or earn more, they may stay stuck in the same income bracket for years, thinking they're playing it safe. Number 2, the scarcity loop. The scarcity mindset subtly tells you there's never enough. I have to hold on to every penny. Over time, this thinking becomes a self-fulfilling prophecy. You might avoid investing because of fear of loss, hoard money but feel constant anxiety, see wealth as something only for others. Even though your bank balance may grow, your relationship with money becomes rooted in lack, not abundance. Number 3, you mistake caution for wisdom. Many people are praised for being great savers, but that's not the same as being financially smart. True wealth building requires a combination of saving, which is defensive, investing, which is offensive, learning, which is adaptive. Millionaires and financially street-smart individuals don't just save, they deploy capital wisely. They invest in assets that grow, relationships that open doors, and knowledge that multiplies returns. While your money sits in a savings account earning 1 to 2% interest, and inflation is quietly eroding its value. So technically, over time, you're losing money by playing it too safe. A healthy financial mindset balances saving with learning, earning, and investing. Don't just protect your money. Position it to work for you. 4. Opportunity cost. Imagine someone who has been diligently saving for years, setting aside money from every paycheck, skipping vacations, cutting back on luxuries. And after a decade, they've managed to accumulate $100,000 in a regular savings account. That's no small feat, and on the surface, it sounds like a wise and responsible financial move. But here's the catch. That money is just sitting there. likely earning less than 1% interest per year, maybe even less when you account for inflation. Now contrast that with someone else who took the same $100,000 but chose to invest it in a moderately performing index fund, which historically averages about 7% annual returns. Over 10 years, thanks to compound interest, that investment would grow to nearly $200,000, essentially doubling the original amount. That's an extra $100,000, earned passively, just from making a smarter choice about where to place the money. The example highlights a critical difference between saving and investing. Saving protects your money, but doesn't grow it significantly. It's safe, liquid, and ideal for short-term goals or emergencies, but it's not a long-term wealth builder. Investing, on the other hand, carries some risk, but over time, it puts your money to work, allowing it to grow exponentially through compounding. Number 5. Savings alone doesn't build wealth on its own. Saving protects your money, but it doesn't grow it. While having a solid savings habit is important for financial security, it's not a wealth-building strategy on its own. Savings accounts preserve what you already have, but they don't have the power to multiply it over time. 6. True wealth is created through ownership, not storage. Wealth grows when you put your money into assets that appreciate in value or generate consistent income. For example, real estate can appreciate over time while also providing rental income. Stocks and mutual funds grow through capital gains and dividends. Businesses create cash flow and can significantly scale in value. These vehicles not only keep pace with inflation, they often outperform it, allowing your net worth to expand over the years. So while saving is wise for short-term needs and emergencies, if your goal is long-term financial freedom or generational wealth, you must think beyond saving and start investing. False sense of security. A large savings account can give the comforting illusion of financial security. But this sense of safety can be misleading if it's not backed by a comprehensive financial strategy. Yes, having cash in the bank is important. It provides liquidity for emergencies, helps cover short-term expenses, and gives peace of mind. But relying only on savings is like building a house with just one wall. Over time, the purchasing power of your money decreases due to inflation. Without investing in appreciating assets like stocks, real estate, or mutual funds, your money stagnates rather than grows. Critically speaking, taking an insurance cover in health, life, business, or property provides the financial protection that savings alone cannot. Temptation to spend. Unless your savings are locked away in a fixed or restricted account, they're often too easy to access, and that can be a hidden danger. When your money is sitting in a regular savings account, or even worse, a current account, it's just a click away. With mobile banking, ATMs, and online shopping, the temptation to dip in for non-essential purchases is high. A new phone, a vacation, or impulse spending can quickly chip away at what was meant to be your safety net. Think of it like this. Having a chocolate bar in your pocket makes it easy to snack, even when you're trying to stay healthy. But if it's locked in a cupboard, you'd have to unlock and climb to reach. You're less likely to indulge mindlessly. Fixed deposits, mutual funds, retirement accounts, or locked investment accounts serve this purpose. They force you to pause and reconsider before withdrawing. Easily accessible savings often come without structure or intention. You're saving, but without defined goals, so it becomes easier to rationalize withdrawals. When savings aren't tied to clear targets like an emergency fund, investment capital, or home ownership, it's easy to use them loosely. Ease of access can sabotage your financial discipline. To truly protect and grow your money, it's wise to separate your savings, keep a small amount easily accessible for true emergencies, and lock the rest in higher yield, less accessible accounts or investments. Limited tax benefits. Savings often offer little to no tax benefits, while many investments can provide significant tax advantages. Let's break that down. When you put your money in a regular savings account, the interest you earn is typically very low, and in many countries, it's also taxable. That means you earn a small amount, maybe 1–2% interest annually. Then the government taxes that tiny bit of interest. So your money isn't really growing, especially after inflation is factored in. In contrast, many investment vehicles offer built-in tax advantages that can help you grow your wealth more efficiently. For example, accounts like IRAs, US, RRSPs, Canada, or pensions allow you to defer taxes on your contributions or growth until retirement, when your tax rate might be lower. Example, you invest $5,000 today and it grows to $20,000 by retirement. You don't pay taxes on it until you withdraw, and even then, at a potentially lower rate. Similarly, when you own property, you can often deduct expenses like mortgage interest, depreciation, and maintenance, reducing your taxable income even as your property increases in value. Savings accounts are simple but offer almost no tax advantage, while smart investments in retirement funds, real estate, or businesses not only grow your money faster, they also reduce your tax burden, letting you keep more of what you earn. 10. Lack of long-term planning. Retirement isn't just about stopping work. It's about sustaining your lifestyle without active income. Many people imagine retirement as the moment they stop working. But that's only part of the picture. The real goal of retirement isn't just to stop earning. It's to live comfortably without needing to work. That means your money needs to keep working even after you stop. Having a lump sum of savings might feel like security, but over a retirement that could last 20 to 30 years or more, that money can shrink fast, especially when you consider inflation. Your money buys less each year. Healthcare expenses, which tend to rise with age. Longer life expectancy. You may live longer than you plan. Unexpected emergencies or costs. If you're only relying on a fixed pool of money, you may run out or live so frugally that your quality of life suffers. Looking at it from a broader perspective, the classical economic thought has long upheld the idea that robust savings are a virtue, but with an important caveat: only when those savings are converted into productive investment. In this view, saving fuels capital formation, which in turn drives economic growth. In other words, money saved today is money invested into businesses, infrastructure, or innovation tomorrow. However, Keynesian economics introduced a compelling challenge to this idea, particularly in the context of economic downturns like the Great Depression. John Maynard Keynes argued that excessive saving, especially during times of economic uncertainty, can actually be harmful to the economy. When households and businesses collectively choose to save rather than spend, aggregate demand drops, which leads to reduced income, lower production, job losses, and ultimately, recession. This paradox is famously known as the paradox of thrift, where what may be wise for an individual, saving more, becomes damaging when practiced by everyone simultaneously. In such cases, rather than stimulating growth, widespread saving leads to economic contraction. Imagine during a financial crisis, people become afraid of the future and stop spending. Restaurants get fewer customers, shops see fewer buyers, and companies delay hiring. Even though people are saving more, the economy stalls because money isn't circulating. Businesses close, unemployment rises, and the fear that drove saving becomes a self-fulfilling prophecy. Key takeaway. So, is robust saving a vice or a virtue? The answer is, it's both, depending on how you use it. If saving is your only strategy, you're playing not to lose, but if it's part of a bigger plan, you're playing to win. Similarly, from a macro perspective, saving is an essential personal finance habit. However, its impact depends on timing and scale. Savings become a virtue when they are reinvested into the economy. But when fear leads everyone to hoard cash, it can starve the system of demand, the lifeblood of economic activity. So what's the smart move you can take? Build an emergency fund, typically 3 to 6 months of living expenses. After that, shift your mindset from just saving to strategic investing. Money is a tool. It's meant to work, not sit idle. Wealth isn't built by hoarding cash. It's built by putting it in places where it grows. If you found this eye-opening, share this with someone still stuck in the save-only mindset. And don't forget to like, comment, and subscribe for more street-smart money wisdom. Until next time, stay smart, stay bold, and make your money move.